Every great founder needs help. They just don't need it from VCs.
Phin, it has been 5 years. So many great things have happened since our last show. But first, thank you so much for joining me today.
Yeah, of course. No, I'm really happy to be here. It's always wonderful to talk to you, whether we're on the show or on WhatsApp. It's always great to hear your voice or read your words.
Man, I so appreciate our relationship. It's one of the great joys of doing the show for me, building friendships like we have. And so huge thanks for that. But I want to start with some context. So talk to me first. Why did you leave First Round? And before you said to me about a co-founding moment and the pursuit of it, can you talk to me about those two elements?
Yeah, sure. Leaving First Round was a really, really hard decision. I think you find your greatest opportunities when you leave the best job you ever had. And I think that's definitely the case here. It was a wonderful, obviously, brand, very successful, wonderful people. But for me, there was always this question sort of eating at me around, was this it? Right? Was this all there was in my venture career? And was there more in the opportunity to build something of my own and find a way to do that and continue to push myself and continue to engage with the edges of what I was capable of by trying my own thing. And so admittedly with some probably COVID-induced navel gazing, in 2020, was looking at the market and feeling the work I was doing and where I wanted to go, and felt like it was a now or never moment. And I had some conversations with Josh and the other partners, and we figured out a path to navigate that was sort of, I think, appropriate and acceptable to everyone. Not the happiest of moments, because anytime these are deep friendships and people that you care for and trust. And in that recognition that you want to go try something else, I think I underestimated the sense maybe that somehow meant that what I was doing wasn't good enough. And that was not at all what I was saying. And those relationships are strong, and it's been some time, and those are, Josh is an investor in the fund and so forth. But navigating that was a challenge, but I think it was sometimes doing the hard thing is the thing you have to do. And I felt like I did that and did it with integrity.
Where do you think the need to have your own thing comes from? Some people don't have it. Like, for instance, mine comes from running away from constraints. I hate people telling me what I can and can't do. And also a desire to be appreciated and recognized for myself, not for someone else, which is probably insecure of me. But those are my two reasons why I had to do my own. Have you ever analyzed why you had to do your own?
There's a question that eats at me about what am I capable of? Like, how far can you go? What can you accomplish? When you attempt to answer that question inside the context of an existing institution, the answers are not easy, but more obvious. You could become a managing partner at the firm. Well, I did that. You could deliver an epic fund. And I think as a team, we had done some of that. You could partner with unbelievable companies, and as an individual and as a team, we did that. You could change the industry in some way with the Review or Dorm Room Fund or Angel Track, and we did that. I had done those things, and I think the question that was eating at me was there more, and what could that be? And it felt like the only container to find out, the only place where that answer existed was in trying to find my own thing and crafting my own approach. And then I was unbelievably lucky in finding someone who had taken that step years before and who was very aligned with me. And so we came together to shape the general partnership in a really, I think, organic, but also powerful way.
We're going to get to the partnership. I do just have to ask, this schedule has gone to the wayside pretty quickly. You said, how much further can you go? I asked the same of myself. The truth is, to me, gosh, I'm going to get in trouble for this. You can always go further alone, without another half, without kids, when it is just you at your desk, meeting founders, focusing. You can do so much more. It is a young person's game of grind and hours, is what I've come to realize. But that scares me.
I think hard work is a huge piece of seeing how far you can go. But I think a piece of my answer anyway, and everybody's different, is how far can you go with your life, your whole life, not just one aspect. Everything has to integrate. Like work-life balance, I think, is not the right model. Like I think you want a life that you're proud of. I think you want work that you're proud of, that weaves into your dinner conversations with your family, that you have time to make and then serve and then eat. Maybe you ask your daughter to clean up because you need to go and get back online and do a Zoom or email. But I think integrating your life and seeing how far you can go as a parent, as a spouse, as a friend, as a venture capitalist, I think all of those things, they weave together. And it becomes, when you have your own firm and you have, it becomes a piece of that life, I think, in a much more meaningful way for me. It is true, young person game. It is true. You got to grind and there are, hours and hours and hours. But I also think there's thought that occurs when you're on your run, and there's work that gets done when you're, off to come home or going to watch a child play a sport. And so I think you can integrate those things and create the life that you want.
Dude, I run for long enough. I have enough thoughts. But I do have to ask, I think this is a really interesting one, which is if you could call yourself up when you were leaving Penn and just about to join First Round, and you could give yourself a piece of advice on entering the venture world, what would you tell yourself knowing all that you know now?
I think there's something in being very intentional about what you're doing and appropriately putting in context the decisions that you're making. Don't set yourself a goal of, being a partner in 5 years, because you probably have very little control over that. But be very intentional about the day-to-day work that you're doing and making sure that is both excellent in terms of quality and helping you build towards the experience that you hope to achieve. And I think too many people, and I probably was guilty of this as well, you come into venture and everybody kind of says, good luck, go find the next Uber, right? And doesn't really tell you how to do that. There's, it's an art, not a science. Everyone practices it differently. But I think you can be intentional about the technical aspects of the job. So I think you can be a student of interviewing, because venture investing starts with an interview with a founder. And you're sitting down with someone and you're interviewing them to learn their ground truth, what they're going after, the way they see the market. And that's an art that it can be practiced. It's also well documented. People do it as podcasters. They do it as journalists. They do it, as members of law enforcement. There's many, many ways to interview. And then the other aspect is coaching, which is also documented and can be practiced. I think you can be very intentional about the technical aspects of the job. You can focus on how to get better at those things day by day. And then you can hold on to the belief that will be the path to your aspirations.
Dude, I've got to go double click on that. You said there about kind of the interviewing there and the art of it. One of the references I did on you said that you are Warren Buffett for founder detection, for really understanding the true qualities of a founder in front of you. Mm-hmm. How have the questions that you ask changed? Are there commonalities to those questions to determine the true quality of a founder sitting across the table from you?
I think I've come to believe that your priorities and the way you express those priorities and explain them is probably the most important thing to understand when you think about partnering with a founder. I like to ask people, what's the most important thing? What's the best thing that happened at your company this week? And in the answer to that question, you have an understanding of what are they excited about? What do they think will drive the business forward? Do they set up the situation as something that happened to them and they were a victim and they overcame it? Or do they set it up as a challenge that they understood like a puzzle and they navigated? There are many, many ways that your priorities and the way you frame the challenges that you have to overcome are telling in terms of how you will lead a company. And I think that if you can ask questions that get at somebody's priorities and their motivations and their operating style, then you learn a tremendous amount about them as a founder. You can start to guess and make an educated guess as to how they will handle the complexity that is certainly coming, the uncertainty that is certainly coming as they lead their business.
You know, one that I love to ask is, how did you first make money? I find very, very rarely do truly great entrepreneurs first make money with a business when they're 23 or 24 or with a job at McKinsey or Bain. They always did something when they were a kid. It could have been anything, cookies, building websites, you name it, but it was something.
No, that's right. That's right. But I think you have to also understand the way they set that up. So for me, I mowed lawns. When I was in junior high school, I mowed lawns. I had a mower and I would walk around the neighborhood and I would offer to mow people's lawns. But then I realized that people wouldn't be home. I'm out, knocking on the door. They're not there. I started offering people, a certain number of lawn mowings per month for a certain amount. And I would ask them how, when the grass gets to a certain length, you want to cut, or do you want to cut twice a month? How do you want to do that? And so within my neighborhood, I had this really nice subscription revenue business where pretty much every house, told me they wanted their lawn mowed somewhere between 1 and 3 times a month. And so then I was able to walk around the neighborhood when I had time and make sure I got to my route and mowed the lawns. And I didn't have to knock on the door. They didn't have to be home. In fact, they'd probably rather they weren't home, and the reason I did that is I found that my friends wanted to play basketball on Saturdays and Sundays, which is typically when I had time to mow. And I didn't, but also when people were away, they were doing their own things on the weekend. So I needed to find a way to be able to mow the lawns during the week. And the only way to do that was to come home from school and mow lawns without people's permission.
I absolutely love that. See, that's what I want to hear. The thing that worries me more is that more VCs have better entrepreneurial stories, I find, than founders. Which is worrying. Is the old Charlie Munger, show me the incentive, I'll show you the outcome. That's why everyone's in fucking venture.
Yeah, we peaked too soon in terms of entrepreneur. Like that's the best that you did, right?
Totally. Listen, I have to ask, you mentioned that, about the ceiling that one hits. And you said, invest in the next Uber, do great as a partnership, build a premier brand. That's what you and the partnership did at First Round. And you were there for 11 years. It shapes how you think hugely. Mm-hmm. If you were to do, say, 1 to 2 takeaways that really impacted your mindset from the 11 years at First Round, what would they be?
I think the first is one that actually I learned before in my work at And1, the basketball company, that then I applied to my decision to join First Round. But it was also Josh's insight at First Round, which is there's tremendous power in being able to focus on a niche. And if you can know your customer better than your competition, and you can craft your product to deliver against that customer's needs in a more salient way than your competition, then you will win. The challenge with niche is that at some point, people look around and they think, oh, now we're ready to expand. Now we're ready to go beyond the niche. And they forget that what made them so successful in the niche is the thing they have to walk away from to try to expand. So at And1, we would talk about running shoes, trainers. We would talk about lifestyle shoes and clothing, kids' licenses, and so forth. And the focus on those things eroded the quality of the brand we had built in basketball and the core understanding of bringing together hip hop and hoops and making that mainstream. And I think when you look at what First Round did in Seed, it's very much the beginning of that journey. It's you own a niche, you focus entirely on a founder at a certain stage, and you work in a certain way. And I think at the General Partnership, we're also trying to do that with founders who want to build their companies in a very specific way. And I think that's a niche that we can try to own.
I'm asking a really unfair question here. I totally agree with you in terms of owning that niche, but then combining that with your statement earlier of how much further can you go? If you own the seed niche, like First Round did, there's a chance you could own the second round. You could own the Series A as well. Many tried and raised opportunity funds, Series A funds. How
did that work out? I think that there are folks who have been able to do that without eroding their brand and without eroding the service. But I think it's a very, very hard thing to do if you define yourself as delivering a service in a unique way for a unique stage of company. And then you expand beyond that. The only way to do that is to say, at that later stage, it's either a different product. We do seed and we do it this way, And then because of our brand and reputation at seed, we earn the right to be on cap tables at the later stage. That's just capital. And we're a commodity capital provider. And our value is that we won't be detrimental. You could take that approach, or you could say it's a separate team, which the mega funds have sort of tried to do and said, we have a separate team that focuses in this different way.
My personal favorite, Finn, is not a conflict. It's from a separate fund.
Oh yeah, exactly. Exactly. Or no, it's really meaningful, this scout investment, because it's in the scout fund versus the seed fund versus the growth fund versus the mega fund. I agree. Back to the original question, I think the lesson of focus is the core lesson that I take away.
I've never actually spoken about this, but I think actually I lost my way with the content that we did about a year ago. I was overly focused on growth, bluntly, and I started doing things with different guests that weren't venture. And you would have a pop star on the show, and it's like, that's not what we're about, and that's not why people listen. It was a really important lesson for me in terms of going back to what makes us good and what makes us who we are, which is what I love, which is this, not, no offense, pop stars.
I would push on that a little bit, because I think your push into 20 sales, 20 product, 20 growth, those are expansions that actually bolster the brand. Right. Totally. And you sort of say, we have a certain style of interviewing that has to do with going very, very deep with experts in a space. So they share their knowledge with folks. We're building community of those people. We've started with VC, but now we're going to choose adjacencies, and we're going to take that same approach. My view, I'm not in your business, but my view of what you're doing is you've created a media property that has tremendous benefit for your venture fund, right? And so those two things are symbiotic from a product perspective, from a revenue perspective, from the value you can provide to your founders and so forth. So I think the whole thing works together. I think as you start pushing into, whether it's pop stars or, the hedge fund managers and sort of, becoming more of a financial, invest like the best type, financial program, I think you lose some of that unique nature of what you're doing. And I don't know what I get when I come to listen to you. The reason I come is because I know what I'm going to get. And I think the same for anyone who's a customer. And I think founders are customers. And I think the way you craft and deliver product matters a lot.
I mean, A, I really appreciate that. And B, I think you're totally right. The pop stars were a real diversion away from the home core. People come because they want to hear about venture from venture insiders, and they want to understand what's going on in the world of venture. But you said to me before something that's fascinating, and I agree with this, starting on venture. Why do you think the business model for venture is broken in most cases, Finn?
I started feeling this way in 2018, 2019. The venture as an industry has evolved tremendously, right? From the 70s when it started, and you had folks like Don Valentine jumping into hot tubs with Nolan Bushnell and investing in Atari. These stories of a cottage industry with people who were maybe a little bit crazy, risk-seeking, but also brought with them deep domain expertise. Back then, it happened to be around distribution and sales, sort of go-to-market expertise for the most part. Partnering with technologists, people who had crafted unbelievable products or deeply understood a new technology, chips like Silicon Valley is because it was hardware. And they would partner with folks who understood go-to-market and distribution. It was a one-to-one relationship. And together, companies would emerge in that collaboration, right? But the one-to-one relationship was the key, and that was a cottage industry. Like any financial, arbitrage, it was eroded away as more and more people thought, oh, there's big returns in venture. I can come down, I can take that risk. And so at some point, the venture firms realized that they had to differentiate, and it wasn't enough to be a smart person with expertise, but you needed to do more. And so you had this industrial revolution in venture capital. And you saw platform teams. And when Andreessen launched, that was when Greylock hired my now co-founder, Dan Portillo, because he was the best recruiter in Silicon Valley, still is. They needed more than capital. So they brought him in to lead recruiting and talent for them in 2011. And he did amazing work, 2011 to 2018. And things kept scaling and platforms kept getting bigger. But the challenge with the business model of venture in a world where you need to differentiate with product, and if you choose to do it that way, and some people who I respect a tremendous amount have chosen not to do it that way, starting with benchmark and working your way down. But I think if you choose to offer more than a individual, very senior partner who can work one-on-one with a founder in a high context way and deliver tremendous value, then the fee and carry model doesn't work, because those services show up as a cost center on the statement, the cash flow statement of the VC firm itself. And so as a good business person, when you see a cost center, you try to do two things. One, you try to minimize that cost. And then two, you try to amortize it across as many customers as you can. And so the result of that work to optimize for the GP business model is you end up with increasingly junior people paying increasingly fractionalized attention to a founder's most critical needs. You see efforts to productize and scale services, and services don't scale, right? You can scale a product, but the way you scale a product is you make it more and more static, you make it more and more brittle, and you make sure that it's more and more generic, and it can meet the marginal needs of many customers, but it doesn't meet the critical needs of any customer. And I think that is the problem with the business model today, if you're trying to differentiate by providing service.
So I think about a couple of things here. One, I think there's opacity between the cost centers that the LPs see and that the GPs have. And what I mean by that is a lot of GPs I find, and I found over the last few years, is that they leverage these extensive teams to justify the large fund size increases. And although the teams are a cost center, the fees that they get with the massive increase in funds means that actually it's just a game of increasing fees, and the cost center doesn't increase nearly as much as the fee game does for them. But it's a good justification with LPs, number one.
And when you say that, you mean to help to have LPs not push back on the 2% fee on $1 billion when it used to be 2% on 200.
Absolutely. You say, well, listen, we have a go-to-market team, we have a sales team, we have a talent team. We really have this unified force that it costs money to build these great companies, and there's 20 people there. LPs go, well, that's a lot of people. I can see that. If you want the best people as well, they cost too. And so it justifies that fund size increase.
Yeah, although I think the fund size increases were about investing bigger checks in more companies, moving faster, deploying more capital. Maybe some of the fee justification came from we built out this service team. Even no matter how big your fund gets, I don't think you ever have the resource to meet the needs of your companies in a appropriate or impactful way. So if it used to be, please come meet with our go-to-market expert. They will spend time with you once a week for 6 months. Then it was, oh, you and a cohort of people are going to come and meet with our go-to-market expert. And then now you're seeing the rise of programs. Everybody has a program, and they're running people through programs in order to add value. And maybe it's an intense weekend with 100 of your, most promising startups, right? I think that there's this constant erosion of value delivery anytime you move away from one-to-one, high context, from someone with deep domain expertise in that given area and someone who's been in the trenches very recently. Like the half-life of operating experience is very, very short now. Things are changing very quickly. And so you need people who are doing this day in and day out and who have tremendously deep experience and they're able to deliver in a way that you can only do, in a one-to-one fashion.
Phin, this is the thesis with the 20 sales, 20 product, 20 growth, which obviously we can leverage for 20 VC portfolio companies. But it's like the decay on operating experience. If you manage teams pre-COVID, manage tech stacks pre-AI or pre-cloud, often as many VCs did, it's a different world. Right. Pre-cloud, pre-AI, and pre-COVID. I'm just going to push, and I hope it's okay. I always say talent teams are largely BS unless you really invest in them. Totally because the diversity of roles that people will come to you for means that essentially you just become a job description writer. Because if you're hiring a CMO, it's totally different to a head of developer relations. A head of talent can't be expected to hire such diverse roles. Am I right, or do you think I'm being unfair?
I think you're completely right, which again speaks to the need for a one-to-one relationship versus a pooled resource. If you look at how the very best companies hire, someone's going to go find a CMO or a VPE. The very best searches, the companies are at a scale where they probably have a head of talent or a head of people. They probably have a recruiting team. They assign that role to a single person who figures out how to understand the needs of the company, how to then go out, identify some candidates for context building with the hiring manager. They then build a pipeline. They set up an interview loop. They bring those people through. They guide them all the way through from evaluation to offer to close. They get them in the seat, and then they help them be successful. And one person will own that, whether that person is maybe an outsourced executive recruiter or someone internally on the team. And that is how the very best searches are done, is that there is a single person who owns that search. They collaborate with the hiring manager and they run it end to end. The best searches are not, oh, you need an engineer? We know a lot of engineers. Here's a Google sheet with a bunch of LinkedIn links. Good luck. That's not recruiting. And so at the GP, when we do recruiting, we do the first thing. We engage with the founder. We understand their needs. We have a person who maybe was the lead tech recruiter at Facebook for, 6 years, or was part of building Stripe's, engineering teams 2 through N, come and sit with that founder and understand their roadmap, and then understand how they're aligning that roadmap with their hiring needs. And then we go out and we build the context, we build the funnel, we bring those people through, and we manage that process end to end. And that accelerates that process. It increases the quality of it. And we can do that because our business model means that work is a revenue center for the firm rather than a cost center, because we earn equity for doing that work rather than paying for that out of fee as sort of some differentiating, factor in terms of how we offer the service.
A couple of questions for you. Number one, amazing. How do you scale that though? I mean, it's like, it's early in the GP's life cycle. Mm-hmm. If we project out 3 to 5 years and there's 60 to 80 companies, say, I'm just taking a number there, how does that quality scale over time?
I think the first answer is our goal is not to scale. Our goal is to maximize quality of service delivery and impact on a smaller number of super high quality companies. We've looked at how the business can deliver that even as the portfolio scales, because you're right that over time that portfolio scales. Every engagement, we work with a founder. We partner with them to understand their needs. We have a written statement of work that we collaborate with them on. That statement of work describes what we will do. It describes the time that it'll take for us to do that, and then the amount of equity they will earn when we deliver success against that statement of work. And those statements of work tend to be somewhere between 6 and 15 months long. They work across recruiting, product and engineering, and go to market. The founders can pick and choose where they need the help, or if they don't need the help at all, we can just invest capital and they can come back to us at some point when they want to engage. But when the statement of work is delivered, then that engagement is over. And if they want to engage, they want to continue with ongoing recruiting support, we need a new statement of work. And that's a new investment for us. And we evaluate that against every other investment that we could make with that same resource.
So a couple of questions here. Like, number one, I had Jason Lemkin and Sam Lessin on a roundtable show recently, and they both said the best founders, they don't need you. Sam Lessin said, if a founder says I need you, I'm like, get out, not for me. Do you think that's fair, or do you think that's actually not the way it is in your perspective?
I think nothing against Sam, but they probably don't need him. Right. That's what he's saying. Right. Like, if someone says the best founders don't need help, what I hear them saying is the best founders don't need my help. And that's probably true in most cases when a VC says it. But I think that if you look at the best founders, they are constantly accessing the very best sources of advice, guidance, and hands-on support and help to build their companies, to achieve their goals and get to their North Star as fast as they can and as at high quality as they possibly can. Every single one. They all have a trusted group of people. They all have folks that they bring into their company who do unbelievable work. Every great founder has that support. And so every great founder needs help. They just don't need it from VCs.
I do actually agree with you there. And yeah, again, it's why I did 20 product, 20 sales, and 20 growth. It was a realization, though, that I'm unlikely to be able to help them, but I should be able to offer a catalog of amazing operators who can help them. But having that awareness that it's probably not me was central.
I think that's right. I think that's right. And I would imagine that success, let's say 20 product, 20 growth, 20 sales are successful. Your founders are accessing those people. They have a conversation. They get some advice. They find it to be impactful. They go back to that same person. They build a relationship. And before you know it, that person who you had on 20 product is now an advisor for that founder, compensated with equity.
I mean, actually, we have 20 sales and 20 growth funds, which we raise for them, and they then invest.
Sure, right. They earn the right. They earn the right onto a locked cap table with their expertise and their advice. They can capture the most valuable asset in the startup ecosystem, which is equity, in that company because of that. Whether they do it through capital or advice, and I would imagine some of them will do both.
Okay, so I completely get you. I agree with you. The challenge that I have now is, yes, better product from us, better service, better quality. But when Andreessen puts, and I'm not picking on Andreessen, but when a big multi-stage fund puts 5 on 25 or 6 on 40 on the table for a pre-seed or a seed round, I get it, Phin, you're great, and I want to work with you, but 3 on 15 versus 5 or 6 on 30 or 40, my job is to capitalize my business, and that can enable me to do X and Y. How do we play in a world like that?
There's a lot of belly aching about the market's broken, the mega funds are coming down. And maybe I think differently about this because I was fortunate enough to have the experience of winning against those firms in the past with lower prices and smaller rounds. And so when I hear people say that, I think you have a product problem. And if you can't convince a founder that partnering with you is what's best for their business in the face of your competition, you need to do something different. And I hear people say, oh, it means I'm not going to chase the best founders. I'm not going to chase the hottest opportunities. I don't have a chance to win those things. And I think you're hamstringing yourself when you think that way. And I think that if you really believe in your product and you really believe what you're doing, you have to test that in competition with the very best funds, the largest funds, and they have a structural advantage. I agree. Their cost of capital is lower than yours. They can write a $5 million check and not think about it. And that's a larger percentage of my fund, of your fund. Makes it hard. But hard doesn't mean you can't win. And I think that you can find the founders that resonate with what you're doing, that recognize that the difference in dilution is something that they can make up for with progress. And the most experienced ones with the clearest vision will make that choice. And we've seen that so far with the GP. We've made 19 early stage investments. And of those, I would say 14 or 15 have been competitive and often competitive with large funds. Even as a new fund, we're not the highest price. We're not pushing for the lowest price either. Like I don't want to do that, but we're not winning on price. I think we're winning because we're offering something different.
Okay, can I ask you, do you notice a commonality in the founders that do choose you over the multi-stage funds? What I see as an example is I see more mature second-time founders choose me or my friends over multi-stage funds with the awareness that the brand actually doesn't deliver the hire, the customer, the help needed. And there's more maturity. I find first-time founders more bluntly just succumb to the brand names.
Yeah, we do. The general partnership product tends to appeal to more experienced founders, folks who are a little deeper into their careers. They've either started a company before or they've worked in industry for longer, so they've seen more. Maybe they've even done some angel investing, so they've seen it from the inside. And they have a true appreciation for the value of what we can provide. And when I say value, it's not the value that we are creating for ourselves. It's the value to them and their business, right? They understand the importance of speed to quality. They understand how hard it is to hire an amazing person and the critical nature of that DNA early in a company's life and all of the opportunity that can open up. They understand what it means to have a world-class technology and product organization in the first year of operation, and what that means, not just for their product, but also for their ability to recruit down the line, their ability to sign up customers earlier in the life of the company, to learn from the market much sooner, because you can touch that market with something that they can appreciate and understand. So the very best founders, I think for us, are those that they have the maturity to have that North Star. They have the maturity to understand their critical needs to get there, and they're willing to do whatever it takes to sort of have those cheat codes along the way in order to make progress as quickly as they can.
Do you have to encourage founders to take your services? And what I mean by that is I speak to a lot of people with platforms, venture platforms, and they say, honestly, you'd be surprised by how few founders actually take us up on the services that we add.
When Dan and I were designing the firm, one of the core things was that it would be an unbundled offering, because we trust the founders to know their critical needs. And we want them to be able to choose where we have a unique product that gives them a specific advantage over the rest of the market, and where we don't. So for example, if someone comes to us and they have their core team, 5-6 people, they're starting to build product, they're sort of heads down on that, and they want to recruit, 20 engineers after they find product market fit and raise their next round, like, we are not the recruiters for that. They should either use an outsourced service, or we can help them hire the head of talent who will do that for them. But that's not what we do. The person that has 3 co-founders and a really strong sense of what they want to build, and they want to engage with, hands-on keyboard, someone like Jonathan Wall, he built Google Wallet. He then built his own company, Index. He sold it to Stripe. He led infrastructure at Stripe for their terminal product. And he deeply understands how to build, early stage companies, infrastructure, et cetera, for scale. And they want to engage with him to figure that out, and then engage with our recruiters to figure out how to sort of build that early team, numbers 4, 5, 6. Like, we do that really, really well. We also do a little bit later stage. So the Series B company that has product market fit, and that product market fit is pulling the company apart, right? They need that critical hire in sales. You're moving from founder-led sales to salesperson-led sales. What does that look like? And you need the VPE to come in and work with your CTO co-founder to make the trains run on time. Who is that person? How do you find them? Design hires, tremendously hard. You're shifting from the founder being the head of product and lead designer to having someone who's going to be head of product, lead designer. And we can come in with rifle shot recruiting there and be tremendously impactful. A recent one, actually, it's interesting at that stage, is integration of the large language models into existing business process. Very, very challenging. And our engineers have been doing that, putting these things into production for our companies over the past, year plus. So they actually have more reps than most in this nascent industry. And so they're in demand to do that. And so I think we unbundled it in a declaration of trust of the founders. And then they come to us with their needs, and we figure out where we have a unique offering and where we don't. And of the 19 investments we've made, 15 of them have done services, 4 of them haven't. But of the 4 that haven't, 2 of them have already come back 6-9 months into the partnership and asked to engage with the services team around specific challenges that they're facing, or specific areas where they want to accelerate their business.
Finn, are you more or less excited about Seed today than you have been in prior years?
The market obviously went through a peak and a valley. And we watched that occur. And I think did it go through a valley? I think that Seed has been immune to any macro cycle. You've seen the migration of large multi-stage funds move earlier. The prices remain really just as high. It's the only place that's remained untouchable. Untouchable until they need to raise their next round.
Totally true.
Right. And so I think that's the valley I was referring to.
Agreed. Right. But then A is the place to be.
Yeah. Maybe, although I think that with Seed, knowing that it's more competitive, knowing that the capital at the next round is harder to come by, I think that just raises the bar on how much of a standout you need to be as a founder and as a company. And I think that it elevates that urgency around execution and delivery. And so I think for us, I tend to be more excited because I think we can give people that advantage in some ways. And I feel like the early stage, and particularly very early, with a lot of what's happening in the market is actually pretty interesting. If you can avoid, I think if you start chasing people up the ladder 5 on 50, 10 on 40. We see these rounds, and I think there's also something with raising too much capital at a certain point where it doesn't make sense for the company. And I think there's adverse effects in terms of the culture at the business if you raise too much. I'm excited about seed and finding the companies that will be building durable businesses, over the next couple of years.
Speaking of finding the companies, I love this question. I got asked it a while ago by a pension fund LP, and I stole it from them because it was freaking great. But it was, there's founders, there's markets, there's traction, and there's market timing. If you were to rank them 1 through 4, 1 being most important, 4 being least important to you in your investment decision-making process, how would you rank them? Founder, market itself, traction, and the market timing?
I think founders are first. And the reason I say that is because the ability of a founder to surprise and to shock you with the way they view a market, the opportunity that they identify that no one else has seen, the ability to execute against that. Like, that is why I do this, is to meet those people. And so if I can't align my business model, my returns with the thing that brings me joy in the work, I struggle. And so I have to start with founders because of that. And then second, I think there's something, if you're investing at a stage where traction can exist, I think that early, it doesn't have to be at scale, but that passion or engagement of a user base is something that is often overlooked because, like, the N is too small. You have hundreds of people that are spending hours or revisiting this thing on a daily basis versus tens of thousands. But I think those early signals should not be ignored. But I think when you're investing before there's a product, like often, our what we call formation stage is sort of that true seed, pre-seed seed, not like the $7 million seed when you've already raised 2 and you have a product in market, et cetera. I think then it's about the market timing. And what I mean by that market timing versus market is the ability to get that early traction. What is it that says now's the time that you're going to be able to find those first 10, 100, 1,000, 10,000 users? You're going to be able to sell in. There's a problem that exists that you can solve. What is it about the market timing that suggests that you can get that early traction? I don't know if it's Peter Fenton or somebody else, kind of like you earn the right to make $10 million in ARR by making $1 million in ARR. And once you make 10, then you earn the right to make 100. And once you make 100, you can make $1 billion. I mean, it's sort of this idea. And I think for early stage investors, it matters much less that there's $1 billion opportunity in a market. There's a TAM that, you can back your way into that suggests that there's, tens of billions to be captured, and you can rationalize to $1 billion in ARR. And it's much more important that the person can earn $1 and only spend, 25 cents to do so.
Can I push your thinking here? We've co-invested before. Well, I've invested after you, which is an important addition, by the way. Not enough VCs make that addition. They're like, we co-invested. It's like, no, I invested in the public markets and you did the pre-seed. But I have to ask, we co-invested before, and it was in emerging economies or emerging markets. Mm-hmm. And what I learned, and my takeaway from that was, no matter how good the entrepreneur is, fuck it. Sorry. If the market is so challenged, which emerging markets are right now, there are great businesses in emerging markets which will never raise because all US cash is off for anywhere in the majority of emerging markets. You're fucked.
Yeah.
And so actually market for me is number 1 above founder. Founders can surprise you. It doesn't matter if your market's destroyed.
So what you're talking about with emerging market is market structure and all of the friction that comes from a less either regulated or mature developed market. I think that's accurate. When I think of market, I think is Uber about owning the black car market, the taxi cab market, or the auto market, or the delivery of all things and transportation market? I think when you get stuck thinking through that and working through the 100 reasons why owning the black car market isn't worth it, then you miss that Travis would figure out Uber X. And I think in that, when I say market timing, this is a team, Garrett and Travis, they are going to earn $1 letting me press a button and take a black car somewhere in San Francisco. Ivan at Notion is going to figure out how to create a digital tool that is as elegant as a blank piece of paper and a pen so that you can create online. And in doing so, he's going to create value. There's no market there. It's not a note-taking tool. If you convince yourself there's a note-taking tool, then you're not interested in that because Evernote wasn't great. And you go down the list, right? I think that when you sort of say there's a vision here and then there's the ability, this market timing means people want this tool to enable them to express their creativity in some way. They want to do these different things. Then you allow that founder, back to sort of choosing founders, to guide that company, within that opportunity set.
Do you think the founder, I oscillate on this one, do you think the founder needs to know what that next chapter is? Does Travis, when he starts Uber, need to know that it's going to go beyond, chauffeurs in an explicit way? I often feel that, you just have to be playing the game to turn over the next card. So many of the things that I've done, I had no strategy to do until I saw the opportunity. You have to be playing the game to see the next play.
Yeah, I've experienced. Yeah, I do. No, it's a great question. I've experienced both. I think that in the first case, whether it's Travis needing to know that there's UberX or it's Ivan needing to know that there's going to be, integrations with Segment and other things, and it's going to become the central data, sort of knowledge repository for a company. I don't think so. I think they need to be passionate about the core product they're building, but they need to know that they want and will find more than just that. They need to understand that this is the foundation of something, that then there will be another act. I've also had the experience with multiple founders where in the first conversation, you sit down with them and they understand their business in 3 acts and they lay it out and then they go after that. And I think for me as an investor, so Rick at Persona was this way. I think Sadi at Avon is this way. And, Sadi at Avon is, okay, it's a HELOC back credit card. Yeah, that's interesting. But what is it really? What it really is moving unsecured consumer credit and the associated interest rates to asset-backed lending and those associated interest rates, and doing that in a way that is efficient and where you can identify customers and offer them a lower interest rate with the same underwriting and risk of default because it's asset-backed, and then be able to shift a huge piece of the lending market. And he sort of laid out, well, first we do this origination model and we understand how to digitally acquire customers for home equity lines of credit. Then we offer that in a credit card form. Then we move to auto and so forth and so on. You sort of build out this big company. And so I think you can have both. But the key thing is in both cases, the founders know there's more. They know they want more than the core thing they're doing. And they also have a deep appreciation for getting the first act right.
I totally agree with you in terms of getting the first act right. I think, when it comes to founder detection, everyone also makes mistakes. The question that I have is, when you review the mistakes that you've made, what did you not see that later became true? Or what did you see that actually wasn't there? Often if I reflect on my own as an example, I fall for the brilliant salesperson, the one who is incredibly smooth and articulate and can present that 3 chapters, but their operational execution ability is not as good as actually their sales ability. And
That's
then
right.
they falter. What would you say your founder detection errors have been?
I think my biggest errors have been, I'm a believer that spikes is what matters. So someone's strongest talent is the thing that you should be focused on. But I think that there are things like the example you just gave, the salesperson who can lay out the 3 acts, but operationally they can't execute sort of to get on stage in the first place, right? That's the challenge. And I think in that case, the quality of that founder, the value they will create is a multiplication problem, not an addition problem. And so if you have a 0 anywhere in a multiplication problem, the value is 0. And I think that my mistakes with founders have been missing the consequences of a weakness and being overwhelmed with the strength of a spike. They won't even be able to apply that spike because they lack something else that will mitigate that strength. I think that's been the weakness. I think I haven't been overwhelmed with someone where I misperceive their strengths as much as I think sort of misunderstanding the impact of a potential weakness.
You mentioned some of the big wins there that the first round have had. I think you learn a lot from the hits and you learn a lot from the misses. I really hope you've had some misses because fuck me, I have done.
Yes.
But my question is, on the biggest hit, what would you say your biggest hit is? And when you like reflect and do a post-mortem, how did it change how you invest?
When I started investing, I was a product person. I built sneakers and video games. My early investments, if I look at them, they were products that I thought should exist. And I have from being a product person, you build up a sort of schizophrenia where you can take on the personality of the customer and have empathy and understand their priorities and needs. And then you could imagine a product that would meet those needs and would resonate. And I think I did a lot of that. Bank Simple, Birchbox, even Blue Apron, I think were those things. And the work I did with Notion, I think was really foundational in understanding the product is a piece of what you're doing, but that understanding the ways that product drives distribution, the power of software platforms versus just an application, and the sense of a product that can can grow with the user and deepen that attachment over time, sort of lock in, I guess you would call it. I learned many of those things from Ivan, Akshay, watching them build that business, helping them recruit people to join that business and seeing it scale. I think the lessons of Notion sort of informed things like Persona. Getting excited about, some of the things that we've done, through the GP, whether that's Avon or Phoenix or Promise on the later side, on the earlier side, when we look at sort of the things that we're drawn to, I think, software only, some infrastructure, security, developer tools, I think leaning into things that become system of record for an important job to be done. I think that lesson kind of came through to me in that first understanding of why Notion was so special.
Can you help me on something, Finn, which is I'm bad when it comes to what I kind of call continuous thoughts, which is essentially when you have a hit in a certain area, you think that area is just continuously a great area to be in. It might be, but it also might be a great founder, a special market timing, a special distribution strategy. Likewise, you lose money in an area and you go, you can't make money there, it's shit. Neither are right. There's always nuance and you have to bring plasticity to every new deal. How do you bring plasticity with big losses and big wins?
I think it's very important to view every company, to the extent you can, as its own thing. Every startup is original and unique by nature because it is a startup. There are certainly lessons that flow across. There's similarities. God knows we heard so many pitches that were the Uber of X, right? People trying to play on that exact thing you're talking about. But I think that the challenge with rules, they can distort your vision, and you have to decide. Same as partners. Anytime you talk to anyone about an investment, anytime you apply a rule that is not, is from one company to another, you're distorting your vision, and you just have to decide: is that corrective or is it blurring? And are you seeing more clearly, or are you missing something? And so I think that the thing to do is to ask yourself, why would this rule not apply? Right? Why is this inappropriate in this case? So ModCloth was a fashion company. They were e-commerce fashion. And there was a belief that the reason that company was working when it was working is that the founder was deep in the vintage clothing space and deeply understood it. She was a buyer. She got all of those things. And so the first time we met Warby Parker, those guys didn't have design sense. Dave dresses pretty well now, but he didn't then. And there was no style person on that team. But the truth is that the glasses had to look good, but that wasn't the point, right? What they had figured out was something entirely different around supply chain and go to market and sort of this D2C motion. And so evaluating their team against the need for someone who had worked at Luxottica in design was the wrong thing to do. And so I think when you have a big win, it's very easy to say, I want to see something else that looks like this. So I want a founder like Ivan, who comes out of design and is quirky in some ways and a genius in most ways, and is just product obsessed and wants to build tools. And that's the way to build systems of record for every company, or for every facet of business. But then you realize that worked for him in a very particular way, and that there's no other company that's built like that, and that most other tools or systems of record are created by, people with different mindsets and other ways of thinking. The airlift one we were just talking about, painful. There's the emerging market stuff, and there's other things. But I think the idea of, like I would look at that one and say, what were the positives? Like what part of that decision was actually accurate, right? Rather than, okay, maybe the overriding lesson is all emerging markets are no good and you just don't invest in emerging markets. And that's a fine lesson. That's fine. And you accept that maybe you'll miss Kareem and other things, right? You just accept that. But I think there's
I'm being deliberately harsh, and I'm actually going to get in trouble for this. If you actually go like, yeah, you miss Kareem, but actually Kareem was grossly overpaid for.
Yeah, sure. Maybe it was. No, maybe it was. Yeah.
And then you can look at actually the whole basket of, Getir, GoPuff, you name it. And these are low margin, bluntly tough businesses, and the opportunity cost of capital is real. GoPuff is now raising, not GoPuff, Getir is raising it, 25% of their last round. Maybe they're just not good businesses to be in.
Yeah, and so I think the analysis, though, the work you owe yourself is to try to find the positive or the thing you got right in the mistake. And it could be that there's not, that the lesson actually is, don't invest in emerging markets, don't invest in these logistically heavy, low margin businesses. That's a great lesson, and one that you could stick to and probably would be a benefit to the portfolio overall, because I do think that there is a reason that most large venture outcomes are software only, and there's something powerful in high margin, zero marginal cost growth businesses.
I say to my mother on walks on Sunday 2 things. I say margins matter, number one. And then I say the opportunity cost of capital is real, which is even if you can make money selling software to restaurants, it's so freaking hard that actually there are easier places with higher upside to put that money.
You will have a limited number of companies in your portfolio. And I think one of the things I'm happiest about with the general partnership model is it's not a coverage model. We are very intentional about building a more concentrated portfolio. We need to find 30 amazing early stage companies. We don't need to be in every amazing early stage company.
30 is quite a lot, though, if you actually think about it. Over a 3-year period, you're doing 10 a year. How many investing partners are there?
So we have Dan and I, and then we have Ben on our team. But the key with us is that, the whole team is involved in the process of investing, from sourcing to picking, winning, supporting, the whole thing. Everyone on our team plays a role. And they play a role by bringing their expertise to that. So if we look at our top of funnel, right? You look at the kind of the sources, 50% of the things we see are sourced by the team, because they are very senior. They have incredible networks. People trust them. And when their friends are starting companies, they come to them and they say, I'm thinking of starting a company. Who should I talk to? And they understand what we look for. They understand the types of companies that are interesting, and they surface those things, to us as a team. And then they're involved along the way. So if we say one of the things that we think about with a founder is how will they build their team? As we think about crafting a statement of work and deciding that we could partner with someone, we engage a member of the talent team to talk with that founder around their needs, how they think about sequencing, and how they think about success and recruiting. On the engineering side, we do the same thing. We deeply understand the way people are approaching their technology, what they're building, and in a way that I think it goes well beyond what I've done in the past. We sit with an engineer in a meeting with a technical founder and have a conversation about the business, about the product they're building, and about how they're building it. And for me, the ability to be immersed in that conversation and to learn the language that the founder is speaking in that context is unbelievable. It's like, if you want to learn Spanish, you would also learn to surf and do that in Costa Rica, right? You wouldn't take a Berlitz class or, put something in your headphones and listen to it.
I think I'd just get Jessica Alba to teach me.
Yeah, exactly.
You can keep Costa Rica.
You have that advantage. But I think the traditional process of understanding what a founder is doing technically is, as a VC that's not technical, you sit in that room, you do your best to understand. You reach out to someone who is technical. You provide some bastardized description of what that founder is doing. That person is probably polite to you and sort of pretends they understand, but then says, well, maybe just connect me with them and I'll talk to them and I'll get you my feedback. Then they do that. And then the feedback comes back and it's again a game of telephone. And then you're making a decision because, some engineer that said it's either good or bad, right? Whereas what we get to do is sit in the room with the founder. The engineer is asking questions not to evaluate what they're doing, but to understand it, to know whether we can help, and to understand it, to know where the holes might be and where the challenges are. And do the challenges that we identify align with the challenges that the founder is seeing? And in doing that, it's just a much deeper process. And I think we involve the team in that. And then obviously on the support side, that's something that we're doing with the team. Advice is free, as it should be. And so if somebody wants to understand how to build a recruiting pipeline, they can spend an hour with one of our team members. If they want to understand how to think about approaching an enterprise for sales, they could spend an hour with our go-to-market team. But I think when you cross over into us actually doing the work, it's very clear. And I think then we have that statement of work, and then we deliver a key deliverable for that company, in a pretty unique way.
Can I ask a bit of a totally random weird one? But I was on this long run today and I was listening to this motivational speeches I do on long runs. And they said that very few people truly understand what happiness is to them. I know it's weird, dude, but I just really like you and I'm just really intrigued to hear your thoughts on this. And I'm so loving this. What is happiness to you?
I think of it in a couple ways. So I can imagine moments in life that would define happiness. So holding your child for the first time, your wedding night, your 20th anniversary of that wedding. For me, and this is strange, but you'll like this. For me, a moment that I know I will be happy and I'll know I've lived a good life is if on my deathbed, I'm looking up at my current wife and daughter and they're smiling at me and everything's okay. That's success. And that means that they have been supported by me in the right ways. It means I have lived with integrity. I've honored them and they're there for me at the very end, and that's whatever it is, 60, 70 years from now, hopefully. But day to day, I think happiness comes from the ability to have impact on individuals that you respect. And I think sometimes it comes back to you. So I got an email this morning that I was sort of sitting here thinking about what am I going to say to Harry? And, and I got an email and a friend wrote me and said he was at a wedding with another friend, a mutual friend of ours. And he has a 7-month-old child. And he was telling this mutual friend, I feel so fulfilled and joyful. Like I feel a joy that I've never felt before. And our mutual friend said to him, I talked to Phin when I had my first child. And he told me, everyone talks to you about, your life isn't your own anymore. And like, you can't go out and you need to see your friends and, all these things. You can't work as much as you want and all this. And he said that what I told him when he told me that was that, yeah, you have a child and it's way less happiness, way more joy. Like that's what it is. You have less happiness moment to moment. You have more joy in these moments that are just beyond. You're holding a child. There's something about that.
And so just so I understand, what does less happiness and more joy mean? I'm
happiness being the freedom to do what you want. Happiness being, you're out with friends. You go for a run when you feel like it. These things versus, changing, what do you call them? Nappies, being up in the middle of the night and so forth. But even when you're unhappy because you're up in the middle of the night and you have a big meeting the next day and you need to get sleep and the baby's crying, there's a moment when the baby stops crying. And the fact that you were there holding her when that happened is joy. It's different. You're still unhappy that you're awake, but there's joy there. And so anyway, but for me, those moments when people say things like that to me, like that makes me happy. Like I went to Dormer Fund, had a 10-year anniversary, and I went, and there was hundreds of people there. It's an amazing community. Molly's done a phenomenal job building it out. It's now independent, spun out on its own. But when I was there, I was talking to people, some of whom I met 10 years ago, 9, 8, 7, 5, 4. Like I met them across this time, and I met them at a time in their life when they were in college, they were figuring out their future, they were graduating, and no fewer than 75 people said to me, hey, you probably don't remember you said this, but you said this thing, and it changed the way I thought about the job to take, the timing of, leaving one and joining another, the way to navigate, some negotiation or some hard time in my professional career, some of them in my personal life. And it was so gratifying to me to know that those little moments that make me happy, giving my thoughts, helping someone work through a challenge, really listening, like truly listening to them, and then helping them discover that answer that's always inside them, the right answer. It's always there. You just have to help bring it out, and getting very, very good at doing that. Do it for founders around strategy, do it for friends around personal situations, but just getting very good at listening and bringing out that person's best answer to whatever challenge they're facing, and then supporting them in going after that. That brings me happiness, and it leads to a moment of people saying thanks and reflecting on that, which is joyful.
I like that. I also really like the distinction between joy and happiness. I find it often quite difficult to separate the two. Listen, my friend, I could talk to you all day. Can we do a quick fire round?
Absolutely.
So let me I'm sorry, I'm supposed to be meeting my mother and she'll kill me. And I'm like, you know what? I better to message before I've done it right. I'm like, you know what? Fuck it. Let's just let her wait. She was not happy. She was very upset. Are you ready to do a quick fire, my friend?
Yeah, absolutely.
Tell me, co-founding moment with Dan. Talk to me about that.
As I was talking about the venture capital business model being broken, Dan was the person who had the courage to do something about it in 2018. And he stepped away from Greylock, storied firm, and he started a business called Sweat Equity Ventures that offered service in exchange for equity. He believed that you could unbundle venture capital from venture services, and he convinced Reid Hoffman to invest in the company. He went out and did the work. He earned equity in amazing companies. That equity is now the portfolio that Reid was the sole LP in. And along the way, I had so much respect for that. We overlapped on a couple boards. And in those board meetings, the founder would move from telling the board what they thought to saying some version of, well, Dan says, and then he would say the answer. And just the impact that he could have on those companies and on those founders was just unbelievable. And so I had always wanted to find a way to work with him. And so when I left first round, I announced publicly I was ready to build again. And Dan was like the second person to reach out. He's the Michael Jordan of recruiting. And he started talking to me about how he could add capital to his model, not about how I could join him in the business. And through that conversation over 14 months, it was amazing because we could just be totally transparent with each other about our goals, our vision for what venture capital should be, the way we wanted to practice. And it turned out that those were completely aligned. And we were able to build a firm, raise a fund that supported his service for equity model, but also added the capital that the founders needed to build their businesses. What is the day-to-day routine? I heard I had to ask this one. I don't always stick to it, right? It's not always, you have your aspiration, then you have your actual life. So that was a caveat with that. But I try to get up early, try to do some reading, try to exercise. I then will make breakfast and sit with my daughter. I drive her to school, drop her off. We have great conversations on the way. Although she's in 7th grade now, so we're carpooling a little bit, and now she wants to take the bus. I'm afraid I'm going to lose those morning conversations. But it's a nice morning conversation with her. Work, till 4 or 5, depends. Pick her up from school if I can. Take her to sports if I can. Spend time on family, dinner, and then go back to work, and then try to get 6-7 hours of sleep and do it again. There's obviously times where you have to do, you're doing dinners. I think a night out, 2 nights out a week for work is appropriate. I have a date night every week with my wife. We have date night. I think that's critical. You asked about parenting. I have so much changes when you have a child, but the biggest thing that changes is the person that you love most in the world. Now there's a third person in the room, and each of you loves that person maybe more than you love each other. And you have to make space for your adult relationship to continue when you have the child in the way. But the daily routine kind of keeps me balanced on those values.
Does the sex stop?
Definitely not.
You don't need to answer that one. The joys of editing. I do want to ask though, you mentioned your beautiful relationship with your daughter there. Taking the question we asked earlier about venture, if you could call yourself up the night before your wife gave birth, what would you advise yourself knowing all that you do now?
I think there's a consistency in prioritizing your family that really matters. And I think that the reason it matters is because what children need is they need something to push on, and they need to know they're safe in doing that. And so I think consistency creates those boundaries, and you set them appropriately. And I think you can make it a practice to truly listen to your child, truly listen, and then give them whatever it is you think they need, which is very different than what they ask for. But give them what you think they need. And if you do that consistently and to the best of your ability, I think you'd be a fantastic parent.
A CPO I had on the show the other day said, children are like users. You listen to their problems and then you can provide them their solutions.
The distinction between what they ask for and what they need is very important.
Absolutely. Yeah. What would you most like to change about the world of venture?
I mean, I think there's been this push to scale, and I think it's eroded the product of venture broadly. And I think that the craft approach, whether you're doing that the way, Chris and Jordan are doing it at Pace, where they do it, or you're doing it the way we're doing it, where in exchange for equity, we deliver a very senior person who works in a one-to-one relationship. But I would love to see a return to the one-to-one relationships that build the best companies.
Tell me, which less well-known firm do you most respect?
So many. I mean, I just mentioned Pace. I think Chris and Jordan are wonderful. I think what Dave Fontenot is doing with HF0 is pretty fascinating. These houses, he brings people in, residential program, but he's got a real nose for talent, and he's doing some amazing things there. I think Meritech doesn't get talked about enough. Max and Alex, I mean, they're just unbelievable in their thinking. And I think so much respect for their focus and what they do. And then, my friend Molly at Dormer Fund, I think is doing amazing work with that community. And I think if you look at the alumni from Dormer Fund and where they've gone on, you can sort of see the quality of the people that she's engaged with and how that community is continuing to form.
You can have dinner with one person, dead or alive. Who's that person and why?
Oh, this is easy. Can I have two people?
Sure.
Bill Bowerman and Phil Knight.
Huh. Why?
Yeah. Founders of Nike, what they built, their partnership, the way they understood each other's strengths, weaknesses, how they work together, and ultimately what they created is just stunning. My long-term professional goal would be to be on the Nike board.
I would love that. How much do you run a week, and what's your pre- and post-workout nutrition?
Anywhere from a week, 40 to 60 miles. I've gotten to the point now where I can go out and run anywhere from 5 to 10 without it's sort of indifferent, just depends on how long I have. And I tend to drink a bunch of water before I go. I tend to work out in the morning, so I don't eat that much before. And then afterwards, I'll just have a normal breakfast. Like, I don't get into the shakes and proteins and all of this. I think if you eat real food and you eat in a balanced way, I think you can be pretty healthy.
I totally agree with you. 40 to 60 is a lot. I mean, I do now like the same. And it is a fucking lot. Like 5 days a week, you do 10 miles a day. Mm-hmm. Shit, that's like, I end up doing like a long one on the weekend, which covers a chunk of it.
Right. That's right. Although, and I've also recently I've mixed in a bunch of cycling. And so it's sort of like, rather than miles, I think of it in hours. So for me, exercise is a meditation. Like, I like to exercise on my own, and so the hours, meaning if I can get 60 to 120 minutes a day, I feel much, much, much better than if I get 30 to 45 minutes.
Totally agree with you. Listen, I want final one. If 10 years out, I said to you, success with TheGP and with Phin, what would you say that would be? If everything goes right, what does that look like?
So I think if everything goes right for the general partnership, we will become an institution that matters in venture capital. When we invest in a company, people will say, congratulations, and they will nod and understand why it makes sense, because we will have a taste that's understood in the market for a certain type of founder, a certain type of company, and a certain way of working. We will have achieved our North Star, which is to be the place that's known to create the best opportunities for the most talented people in Silicon Valley, whether that's a builder on our team, someone that we place into one of our companies, or a founder that we partner with. I think creating the very best opportunities for the most talented people and doing that on a repeated basis is the sort of the North Star for the firm and the fuel that will serve us as we travel over the next 10 years.
Phin, I said at the beginning that kind of friendships like this is really the biggest joy of doing what I do. I think I got a little bit lost again when I focused on the outputs of shows and actually realized that the joy is in the doing and the building of the relationships and not the titles or everything that comes with it. And it really is friendships like this that make me so appreciate what I do. So thank you for all you do for the ecosystem, but for your support for me. And I've loved doing this, man.
Yeah, no, it's been great. Great to talk to you always. And there's focusing on the process. That's the key. And find happiness and joy in that, and everything else will work out.